My next guest says the data will reassure the Fed that its decision to pause was justified, and she thinks we get 0 more cuts this year. Joining us is Diane Swonk, chief economist at KPMG, and CNBC senior economics reporter Steve Leisman. Welcome to you both. Diane, I am going to go right to you because last time we talked just a week or two ago, we were still thinking a couple of cuts, and now you think are they really off the table entirely?
I think they're off the table if we really believe that tariffs are coming through, and I do believe we're going to see some tariffs. Now, how much we see in tariffs does matter, and how much they stay on matters, how long they stay on. But once you put tariffs in motion and once you actually apply them, they're very hard to peel back. And the escalation, as we saw, even with just the few days of escalation that we saw in the beginning of February, was pretty dramatic. So things are moving at a fast pace, but this is important because the Fed has enough information today to feel confident that they moved to the sidelines. The economy is on solid footing. The labor market is still strong. And that the revisions that we saw to 2024 were more for the first half of the year. The back half of the year actually saw upward revisions, especially late in the year, which underpinned the strength that we saw in consumer spending, notably in services. That's really important because that's the part of inflation that's been the stickiest.
Yeah, absolutely. Steve, the shocker today, the absolute headline. It was not. Remember how much we talked about the jobs report yesterday? And then at 10 a.m., consumer sentiment comes out and it drops and expectations drop. And the near-term one-year inflation expectations jumped a full point to 4.3%, one of the biggest jumps we've ever seen. And 27% of consumers spontaneously cited tariffs as a reason.
It's a remarkable. Let's be clear of the tail of the tape, guys. If you have that S&P 500 futures chart, the market was fine and cool with the jobs number. So we shouldn't be saying that the market's down or mixed. It was up from 8:30 to about 10 o'clock. Then 10 o'clock, this shocker comes out. What you're looking at there, which is interesting, is 2 legs downward, and I can tell you exactly what happened. The first leg is the 4.3% one-year inflation rate, and I'm going to come back to Diane in just a second. And the second leg down is the wire moment when Trump said reciprocal tariffs.
Right, that also happened.
So the president is doing all he can to tank his own stock market and his own economy. If you don't mind, I think you should get off that. All of that sums up as more and more people moving into the Swonk Fed camp. If you look at the probabilities now, what you'll see is that they're really barely in 1, and they cannot get to 2. So what are those numbers there? That's they're
yellow is, call it dawn, and blue is now.
Right, dawn. Dark 30, as we like to say. And you can see there's still 1 cut baked in, but they can't get to that second cut. And they're not really all that wonderfully happy about the first cut even. So it's there, but as long as these inflation numbers are high, and I would point out we interviewed Neil Kashkari this morning. He said, I'm wait and see.
And did even Goolsbee, am I wrong, was he on the wire saying potentially this is not an economy that looks like it needs more cuts? He's been one of the biggest doves.
He has been a dove. I didn't see those Goolsbee headlines, so I'll take your word for it. But Kashkari's like, I do think we can go lower. However, I got to wait and see what happens on the fiscal side.
Diane, there are some, Nancy Lazar over at Piper Sandler, I mean, to her, she sees signs that core inflation is reaccelerating. We were all excited when shelter inflation finally started to moderate. When core PCE and core CPI the past few months, that's what got bond yields of 10-year back below 4.5%. But she says, look at M2. Look at just kind of different signs of price pressures in these she's sort of saying it's not idiosyncratic. There's a reason that we keep having sticky inflation, and maybe we're not going back down to 2% anytime soon.
Well, and that's the clear issue. Underlying inflation rate, once you strip out the shelter costs on the super core service sector inflation, that's running well over 1% what it was pre-pandemic. And unless we get that to slow down a lot, we're not going to see the improvements in inflation that we need to see for the Fed to feel fully comfortable in cutting again, and that the target rate that we see on inflation will return to the Fed's target anytime soon. And that's one of the key issues. We saw during the holiday season, we talked about this before, incredible number of vacations, record number of vacations in the month of December before we got to the actual holiday break, which also broke records. And coming into the year, we're seeing a lot of things like airline fares continuing to go up, that which my daughter, I think, single-handedly helped do by buying last-minute tickets to come home for the holiday holidays. But I think these are important things to remember because those are parts of the service sector that remain buoyant. Now, there was an imprint on the job numbers in terms of the fires in California. We had 591,000 people who could not go to work because of inclement weather. That is the highest January on record going back to 2011, which there was big blizzards that disrupted it. So we did see some weather effects in there. And also there were layoffs in the accommodation food services sector, which I think were very much related to the fires in California.
And